Welcome, Masterclass students, monthly service members, and the CTKS family to the CTKS Market Pulse, your daily run-through of how the markets are moving from different perspectives. We'll cover off stocks, crypto, golds, yields, forex, and more in this daily briefing to get you prepared so that you can transform fear into courage to be more of a financial blessing to yourself and those you love. Let's run the numbers. Welcome back, everyone. I'm very grateful to be sharing this time together. What we went through in that introduction was some very key data points. You can see that the federal funds rate will not be increasing in the next FOMC meeting due the 1st of November. You would have also seen that the increase in yields has been driving the futures down. That's been causing so much panic, the Fed doesn't want to fuel that fire. The crypto market is vitally important to look at. It's the barometer for risk in global markets. What is crypto telling us right now? It's telling us the Fed will not increase interest rates. It's also telling us that risk on is on its way. If you read the news headlines, you're just going to run scared straight for the door. People want certainty, but that's not how financial markets work. Your return is because of your risk. You just need a strategy to handle the risk, to be certain that you'll know what you'll actually do if price goes up, goes down, or goes nowhere. This is what we call three-dimensional risk management, and it's vital to apply each and every day. The Market Pulse is all about looking across markets. It's about determining the risk level across different financial markets, and of course starting with crypto is absolutely the best idea. Crypto is the most risk-sensitive market on the planet. We can see that Bitcoin is coming up, and we can see also the top 124-hour percent gainers: BSV, Solana, Injective, Stacks, Aave, Mina, Leo, Mantle, eCash, and MX. The greatest losers past 24 hours: Trust Wallet, Ape, HBAR, Sui, Neo, Theta, Curve, Rocket Pool, The Graph, ICP. There's not been any chaotic liquidations inside the crypto market. We've seen 24-hour liquidations come in a little north of 64 million. Just literally slightly more longs than shorts. It's a pretty balanced market at the moment. And when we look at these red areas, what we're seeing is shorts getting liquidated. When the shorts get liquidated, they drive the price up. When the longs get liquidated, they drive the price down. You can see that a little bit more clearly here. You can see these short liquidations and you can see price is turning around. We were talking about getting a bounce yesterday. That's what we got. But if you listen to the mainstream media, the mainstream news, you would have sold out of the market. We let the charts tell us the news. The news inside the crypto market, we can see fear is decreasing. This is really good because when fear increases, everybody runs for the hills. Having a look at the market analysis tab on ctksnews.com, we see that the initial jobless claims, and this was a high impact survey, a high impact data release, came in lower than anticipated at 198. We've been paying particular attention to the yields movements, especially the 10-year, and the 10-year really took off in the past trading session. When yields go up, the price of money goes up, therefore the cost of debt goes up and market valuations come down. And we can see in the last trading session, Tesla got absolutely smacked, down 9.3%. We'll have a look at Tesla's market structure. All sectors in the main market were red except for communication services, which was only up literally 0.33%. But the markets weren't down dramatically, under 1%, all sectors. In fact, 0.85%. It's critical to convert fear into courage. Price is always moving in a wave, and if we're lucky enough to get down to extreme fear, that's often the best time to buy. Because what happens in periods of extreme fear, everybody leaves the market. There are so many bargains to be found. We can see that risk-on activity is returning to the main markets. If you read the newspaper headlines, you would just be hiding under your bed. That's why we let the charts tell us the news. What news are the charts telling us? They're telling us that the fear gauge of the market is going up currently. That's putting negative pressure on the major indices, stocks, but not crypto. We can see crypto is going in the opposite direction. Crypto is very sensitive to risk on and risk off behavior, especially the yield-based behavior. This may sound like a bit of a contradiction, but I'll explain as we go through. We can see the yields are exploding up, and we've seen the 10-year hit a fresh air gap, and you would only have known that if you've marked up your charts with the CTKS method. The bond market continues to be smashed, undoubtedly. There is a flight to safety into gold. It initially started very, very small, but it's gathered pace and momentum. Gold is doing particularly well. With the probability that the Fed will not increase the federal funds rate, the dollar is starting to stall, and that will also stall interest rates. In other words, the US 10-year and the US 2-year. They're in fact doing their capitulation event, their positive capitulation event, while the bond market is doing its negative capitulation event. These are the ultimate times to be in the market. We can also see that oil is making a resurgence. The thing to note are that junk bonds are coming down at the moment. This is a basic risk-off signal. When you look at the financial markets, and if you're looking for just one probability, it's going to go up or it's going to go down, you need to instead stack probabilities. You'll get conflicting signals out of the market, but in all, if you look at the structure, it will start to make sense. CTKS structure is incredibly important to understand. Always start with the Tier 1 charts first, and monthly service members make sure that you look through your Tier 1s each and every day. And please note, I've updated the gold indicator due to the Hamas-Israel war. The 10-year was updated 2 days ago. Inside the videos, inside the service, you'll find the instructions how to update your indicators. In yesterday's video, Silverbyte said CTKS Structure is the digital gold standard. Thank you, my friend. When we look at the S&P 500, if we mark it up with the CTKS method, we need to go back to 1871 to start to do that. The CTKS method is quite involved. A lot of people say, just explain it to me in 10 seconds. It's not like that. It requires 2 levels of certification to do. But the outcome is magical. What is this magical outcome? We can see the true support and true resistance lines inside market structure. That is total market structure. How do we do that? We just pop on the indicator. What is it telling us about the S&P 500? There was a very strong level of total market structure support at 43.14. We call these levels, these dotted lines, SLs or Stanfield levels. A Stanfield level will tell you how powerful support or resistance levels actually are. This is a fairly weak support level at 42.75. Most importantly, if you have a fresh air gap, it means the price can pull down very, very quickly. We're currently seeing that fresh air gap reflect on the futures. If you want to know what the futures are, they're the first chart that I showed you today. Every chart I show you is very significant. One thing to understand, these levels are magnetized levels. That means if price dips below them, it's seeking to come back to it at some stage. And if it can't maintain an upward bias, it's going down to the next one, and so forth and so on. These structural levels literally contain price. Price is always moving, SL, Stanfield level to Stanfield level. And the CTKS structure gives you the map of where price can be moving. We're particularly interested in these stronger lines. If we saw that we lost this very powerful 43.72 mark, we couldn't hold on to 43.56, then the 43.50 and the 43.25 mark came into play. We couldn't hold 43.25, we were headed down to 43.14. The difference is you know where the levels are. That's the incredibly important point. If you know where the levels are, you're not guessing. This is total market structure. Many people think that the CTKS method must be pretty straightforward. It's actually quite complicated. Level 1 certification, there's a lot that you need to know, and you can see some of the content just here. Of course, it's a standards-based process as well. Level 1 gives you the foundations, but Level 2 gives you the entire structure. And Level 2 is pretty complicated, but it's very important knowledge. Without Level 2, you cannot draw up the SLs. Therefore, you need both Level 1 and Level 2 standard certification to do these drawings. Or you can simply get the indicator as the monthly service members do. Level 1 and Level 2 standard certification is also provided inside the masterclass as an LV series. Inside the monthly service, I also do three-dimensional risk management, and when we look at Tesla, we can see that Tesla has fallen from the positive stance to the neutral stance to the negative stance. Price action is always doing this. It's always bouncing between different cases. The key is to understand where those cases are on a normalized price perspective. Masterclass students, I'm preparing an LV for this three-dimensional risk management paths for you. The shocks that have hit Tesla recently have been pretty severe, but the concept is between 197 and 213, there's a negative fresh air gap. That means the price could collapse very quickly. You should be aware of this on Tesla. If price starts to enter that zone, just be aware of that. Don't panic about it, be aware of it. If you're a long-term holder in Tesla and you believe in it, well, that's the ultimate time to dollar cost average in if that is your thesis. Experts can never tell you what to do. You must press the buy and sell buttons yourself. However, market structure, total market structure, can tell us where areas of opportunity are. As Silverbyte said, the CTKS structure is the gold standard digitally. And why is that? Because if we look at the DXY since 1967, which is about 20,700 days ago, the total market structure levels have been marked up with the indicator. I'm going to pop it on in a moment, but I'm just going to show you where those levels are. If you're going off recent indicative price, you could look towards saying, okay, I'm just going to assess where the major support and resistance lines are over perhaps the past nearly 3 days. 3 days divided by 20,700 is a rounding error. It doesn't mean anything. When you see people do this kind of analysis, be very aware that it's not institutional grade analysis. Institutions just don't do that. They look at all of price action because they need to. They're putting tens of millions or even billions of dollars on the line. Smart money also needs to know how strong a particular level is when a recent indicative price line is drawn out. For example, somebody would say, oh, there's resistance here. I see this top and this top. Oh, do I go from the top of the wick or do I go from the candle? Oh, I'm not sure. But this is what a retail person would do. But we don't do that at all. What we do is mark up the charts with level 1 and level 2 standard certification, and we realize the resistance level isn't there at all. It's down here, and it's a strong one. And what we also know is where the other support and resistance levels are inside the market, going back and spanning over 20,000 days worth of data. According to the standards, we're not guessing, we know where the safety nets are, and we can see price interacts with them really traumatically. This very strong structural now resistance line at 106.2432, you can see price came down and tapped it. If it's not going above, it's going below. And if it's not going below, it's going above. But how did price react to this particular line? We got some really interesting economic data, and it created immense turbulence in the market, but these structural lines caught it, and these structural lines have been inside the indicator since the start of the month. So it's important to understand these lines don't change unless the month changes, and then they change. What we're seeing right now is the DXY is under levels of resistance. It's come down and caught several smart money buy safety nets and has been rebounded up to this resistance. If it can get above 106.2432, it's headed up to the next SL, which is 106.4342. The actual probability of that is not necessarily great because the federal funds rate probabilities of a Fed increase have dropped to a hold. This is critically important at the moment. The yields are spiking, and we'll have a look at those just in a tick, but the DXY is a very good barometer if yields can keep their upwards direction or not. The CTKS Masterclass is incredibly powerful because it draws together the associations between all these different charts. When we look at the US 10-year yield, let's just pop on the indicator. Now this is indicating where the structural support and structural resistance levels are. I was mentioning be careful if we get above a certain level because we're getting into a fresh air gap, and that's a fresh air gap we don't want to see. This is what's causing so much fear inside the market at the moment. Fortunately, there's very strong structural levels around this 505 level, so even if we come up and tap this, we should start to get rejected. And if we get more people understanding that the federal funds rate is not increasing, the institutions already know, that probability will start to push the yields down and start to bring risk back into the market. And we can see the optimism inside crypto and inside the stock market itself is actually improving at the current time. It may not feel like it, but that's exactly what's occurring. Whatever the chart is, price is always moving SL to SL. If it can't get above, it's going below, but if it does get above, it's going to the next one. It may not be an easy path to the next one, but it's going there. And if it can't get above, it's going down to the one below. This just takes out so much stress inside financial markets. But these particular levels, the lines are provided inside the service. I'm just putting the numbers here for you just to make it easier. What is this chart actually telling us, and how do we stack probabilities? I've been saying that the smart money already knows that the Federal Reserve is not going to raise interest rates. It's going to hold them or even cut them. I showed you that chart at the start of the video. This means that even though the 10-year is rallying, it is probably going to lose steam, and as it is in a fresh air zone, it could drop very, very quickly. We can see how the structural levels are obeyed. If there's a fresh air gap below price, it can get filled very, very quickly. So just be aware that the US 10-year could drop like a brick. Gold has been going parabolic as far as gold goes because of the Hamas-Israel war and the threat of a widening conflict. Also, geopolitical instability across the world is helping gold actually, as well as debt problems in the US. But the key for us is very, very straightforward. Price is always moving structural level to structural level. So what are those levels? And remember, gold's been around since 1833, not just a couple of days, not just a couple of years. 1833, that's a long time. Where is smart money buying and selling? We can see the gold piled through after a while that 1955 level. That was a critical one, and it tried to get through so many times. Eventually it did. When it came to the 1963 level, it did really well. But the problem is this: as you go through more and more resistance levels, you'll see the price curves over. Now, why does it do this? Because the sellers are gathering more and more momentum. What are we seeing here? That there are two smart money levels, 1973, which is a support level, and 1971. If it's not going below, it's going above. So therefore, where is the next one? Fantastic news, it's at 1985, so we've got a bit of a fresh air gap, but don't forget the sellers came in and trying to push all of this price down when it gets through a resistance level. That's why having the indicator will tell you how strong or how weak these levels are, if there's a fresh air gap or if there's not, how strong the resistance levels are and how clustered they are above price, and how much support is below price. A vitally important skill is a psychological one. It's your three-dimensional risk management. I invented this area because I saw so many people were struggling with their risk management. They said, "Ken, what do I do? How do I buy or sell?" The answer to that is that only you know how you can buy or sell. The first thing that you need to do is to get your knowledge. You can just imagine it this way. Some influencer says, "Oh, you should sell here or you should buy there." The concept is, what is your strategy? Are you a day trader? Are you a swing trader? Are you a 50-year investor? Is the money just parked there, or are you trying to live from your profits? You can see it's a multi-dimensional thing. That's why you need to have the knowledge. You need to be able to stack probabilities, and you need to know where the structural levels are so you can take control. You must know what you will do if price goes down, goes nowhere, or goes up. And of course, different people are doing different things. Some people are shorting, and some people are going long. Some people are using spot, and some people are using 100x leverage. To say one size fits all is just bananas. You must get the knowledge. Your learning is your earning. Thank you, Michael. The crypto market will definitely go mainstream in 2024. A lot of people in crypto are very forward thinking, but the majority of people are out of crypto. They don't even comprehend what it is. It's just the next evolution of the internet or Web 3.0 from Web 2.0. It's just the internet of money, and it was inevitable. Governments cannot stop it. You can see that the governments have tried everything to stop crypto, but it's just not working. Now the banks and largest financial players have positioned themselves really well, and this negative price momentum inside the markets is just the key time for them to accumulate. There are always opportunities inside the crypto market, and it doesn't matter what prices are doing in the main markets. If you can identify opportunities, you're going to do really, really well. The crypto market is an incredibly volatile market. It's the most volatile asset class on the planet, and therefore it measures risk incredibly well. The Bitcoin spot ETFs are coming. There's a flood of them. And this is just the start. When they start getting approved, there will be a tidal wave of them. Looking at CTKS Structure, we can see that there's a fairly immense amount of upward resistance between 28,581 and 29,322. There's a structural support at 28,426, one at 27,821, and another one down at 27,288. If you're a member of the monthly service, or if you've marked up your Bitcoin chart with level 1 and level 2 standard certification, you know exactly where the levels are. And of course, how strong they are. The reason that we don't just mark up recent indicative price with Bitcoin, it's been around nearly 5,100 days. Just marking up a day or two, or a week or two, or a couple of weeks, and saying this is the most important trend line, and if this happens, is just pretty much rubbish. Or, as we would say, it's non-statistically significant. It's insignificant, literally. So therefore, when we mark up with the CTKS method, what we're actually doing is marking up all of these 5,100 days worth of data to get these levels out with the level 1 and level 2 standard certification process. You can guess, or you can let other people tell you where the levels are, or you can mark them up yourself. Something else that smart money is keeping their eye on: inverse reverse repos. We can see that the financial markets are actually being flooded with money, and there's no commentary on this in the mainstream media. But we've been tracking this for a while, and we can see that in fact we're being supported by the government underneath and behind the scenes. Bitcoin and total crypto market cap is feeling it as well. From nearly 40 years inside financial markets, I can explain that the markets are always on the edge of a knife. It seems like any second things could just fall over and you would be cut to shreds. This is the fear that institutions use to get you to get out of a trade at the wrong time and get into a trade at the wrong time as well. At the point of maximum optimism, it is maximum risk, and the point of maximum pessimism is the maximum point of opportunity. To master fear, we must stack probabilities. Looking far and wide and making sure that you learn as much as humanly possible, not from a retail perspective, and the majority of knowledge out there is retail, especially that on YouTube. If somebody wants to get you excited and hype you up, that's definitely retail knowledge. Professional knowledge is not like that at all. Professionals know they have to put in the hard work. They have to turn up each and every day, even when they don't want to. They are dedicated and committed. They understand how to stack probabilities and what all the different charts mean. They know where the true support and true resistance levels are inside the market, and they make sure that they act accordingly. They understand that price is always moving in a wave. And by knowing where the CTKS structure is, they can make more informed decisions. They focus on creating an understanding of the market pulse. They know where the CTKS structure is, and they let price be the reality, not newspaper headlines, and not the opinions of other people. They make sure they do their daily three-dimensional risk management, and they create flexible rules that change as market conditions change. They get on the right side of the percentage with an abundance mindset. At the heart of everything they do, they must know where the true support and resistance lines are and focus in on the Tier 1 charts first. Then stack probabilities against each of the Tier 1s and also the supporting Tier 2 and Tier 3 charts. Most importantly, they understand Rule 4. Price moves in waves. Price is always going up and down. Even if the market is moving in a specific direction, it may take time to get there. Just keep that one in mind. Price is always moving in a wave. It's a game-changing rule. Keeping positive is really important, so that's why we have the CTKS Creed. This gives us daily affirmations for abundance, financial success, and happiness. All results come from the mind, therefore a better mind creates better outcomes. Our thoughts are largely built on habits. Therefore, creating a positive habit creates a more positive life. We are dedicated and committed. We either learn or win and never blame. And we know that learning is earning, and there are no shortcuts to success. Thank you for being here and spending this time together. How do you feel the markets will move via your stack probabilities? I'm really looking forward to your comments, and if there's anything that you would like me to cover off day to day, please let me know. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.